Como siempre, bienvenidos al curso de Corporate Finance. Continuando con la clase anterior sobre Financial Statement Analysis, hoy les presentaremos uno de sus tipos, que es el Balance Sheet. Cabe destacar que el contenido está basado en el libro Corporate Finance by Jonathan Berg and Peter DeMarzo. In the balance sheet, also called the Statement of Financial Position, we can find the firm's assets and liabilities, providing a snapshot of the firm's financial position at a given point in time. The table shows the balance sheet for a fictitious company, Peru Corporation. Notice that the balance sheet is divided into two sides, with the assets on the left side and the liabilities on the right. The assets list the cash, inventory, property, plant, and equipment, and other investments the company has made. The liabilities show the firm's obligations to creditors. Also shown with liabilities on the right side of the balance sheet is the stockholders' equity. Stockholders' equity, the difference between the firm's assets and liabilities, is an accounting measure of the firm's net worth. The assets on the left side show how the firm uses its capital, its investments, and the right side summarizes the sources of capital, or how a firm raises the money it needs. Because of the way stockholders' equity is calculated, the left side and right side must balance. The balance sheet identity is assets must be equal to liabilities plus stockholders' equity. In the table, total assets for 2016, 179.3 million, are equal to the total liabilities, 154.6 million, plus stockholders' equity, $24.7 million. In the table, if Peru's assets are divided into current and long-term assets. Current assets. Current assets are either cash or assets that could be converted into cash within 1 year. This category includes the following. First, cash and other marketable securities, which are short-term, low-risk investments that can be easily sold and converted to cash, such as money market investments like government debt that matures within a year. Second, accounts receivable, which are amounts owed to the firm by customers who have purchased goods or services on credit. Third, inventories, which are composed of raw materials as well as work in progress and finished goods. Fourth and finally, other current assets, which is cash out category that includes items such as prepaid expenses, such as rent or insurance paid in advance. Long-term assets. The first category of long-term assets is net property, plant, and equipment. These include assets such as real estate or machinery that produce tangible benefits for more than 1 year. If Peru spends $3 million of new equipment, this $3 million will be included with property, plant, and equipment on the balance sheet. Because equipment tends to wear out or become obsolete over time, if Peru will reduce the value recorded for this equipment each year by deducting a depreciation expense. An asset's accumulated depreciation is the total amount deducted over its life. The firm reduces the value of fixed assets other than land over time, according to a depreciation schedule that depends on the asset's lifespan. Depreciation is not an actual cash expense that the firm pays. It is a way of recognizing that buildings and equipment wear out and thus become less valuable the older they get. The book value of an asset, which is the value shown in the firm's financial statements, is equal to its acquisition cost minus accumulated depreciation. Net property, plant, and equipment shows the book value of these assets. When a firm acquires another company, it will acquire a set of tangible assets, such as inventory or property, plant, and equipment, that will then be included on its balance sheet. In many cases, however, the firm may pay more for the company than the total value of the assets it acquires. In this case, the difference between the price paid for the company and the book value assigned to its tangible assets is recorded separately as goodwill and intangible assets. For example, if Peru paid $27 million in 2014 for a firm whose tangible assets had a book value of $7 million, the remaining $20 million appears as goodwill and intangible assets in the table. This entry in the balance sheet captures the value of other intangibles that the firm acquired through the acquisition. For example, brand names and trademarks, patents, customer relationships, and employees. If the firm assesses that the value of these intangible assets decline over time, it will reduce the amount listed on the balance sheet by an amortization or impairment charge that captures the change in value of the acquired assets. Like depreciation, amortization is not an actual cash expense. Other long-term assets can include such items as property not used in business operations, startup costs in connection with the new business, investments in long-term securities, and property held for sale. The sum of all the firm's assets is the total assets at the bottom of the left side of the balance sheet in the table shown. Liabilities. We now examine the liabilities shown on the right side of the balance sheet, which are divided into current and long-term liabilities. Current liabilities. Liabilities that will be satisfied within 1 year are known as current liabilities. They include the following. First, accounts payable, the amounts owed to suppliers for products or services purchased with credit. Second, short-term debt or notes payable, incurring maturities of long-term debt, which are all repayments of debt that will occur within the next year. Third, items such as salary or taxes that are owed but have not yet been paid. And deferred or unearned revenue, which is revenue that has been received for products that have not yet been delivered. The difference between current assets and current liabilities is the firm's net working capital, the capital available in the short term to run the business. For example, in 2016, if Peru's net working capital totaled $12 million, $60 million in current assets and $48 million in current liabilities. Firms with low or negative net working capital may face a shortage of funds unless they generate sufficient cash from their ongoing activities. Long-term liabilities. Long-term liabilities are liabilities that extend beyond 1 year. We describe the main types as follows. First, long-term debt is any loan or debt obligation with the maturity of more than a year. When a firm needs to raise funds to purchase an asset or make an investment, it may borrow those funds through a long-term loan. Second, capital leases are long-term lease contracts that obligate the firm to make regular lease payments in exchange for use of an asset. They allow a firm to gain use of an asset by leasing it from the asset's owner. For example, a firm may lease a building to serve as its corporate headquarters. Deferred taxes are taxes that are owed but have not yet been paid. Firms generally keep two sets of financial statements, one for financial reporting and one for tax purposes. Occasionally, the rules for the two types of statements differ. Deferred tax liabilities generally arise when the firm's financial income exceeds its income for tax purposes. Because deferred taxes will eventually be paid, they appear as a liability on the balance sheet. Stockholders' equity. The sum of the current liabilities and long-term liabilities is total liabilities. The difference between the firm's assets and liabilities is the stockholders' equity. It is also called the book value of equity. As we stated earlier, it is an accounting measure of the net worth of the firm. Ideally, the balance sheet will provide us with an accurate assessment of the true value of the firm's equity. Unfortunately, this is unlikely to be the case. First, many of the assets listed on the balance sheet are valued based on their historical cost rather than their true value today. For example, an office building is listed on the balance sheet according to its historical cost net of depreciation, but the actual value of the office building today may be very different. and possibly much more than the amount the firm paid for it years ago. The same is true for other property, plant, and equipment as well as goodwill. The true value today of an asset may be very different from and even exceed its book value. A second and probably more important problem is that many of the firm's valuable assets are not captured on the balance sheet. Consider, for example, the expertise of the firm's employees, the firm's reputation in the marketplace, their relationships with customers and suppliers, the value of future research and development and innovations, and the quality of the management team. These are all assets that add to the value of the firm that do not appear on the balance sheet. Market value versus book value. For the reasons cited above, the book value of equity, while accurate from an accounting perspective, is an inaccurate assessment of the true value of the firm's equity. Successful firms are often able to borrow in excess of the book value of their assets because creditors recognize that the market value of these assets is far higher than the book value. Thus, it is not surprising that the book value of equity will often differ substantially from the amount investors are willing to pay for the equity. The total market value of a firm's equity equals the number of shares outstanding times the first market price per share. The market value of equity is often referred to as the company's market capitalization or market cap. The market value of a stock doesn't depend on the historical cost of the firm's assets. Instead, it depends on what investors expect those assets to produce in the future. Ahora, para poder entender un poco mejor estos dos conceptos, del market value y el book value, veamos el siguiente ejemplo basado en EF Peru. Problem: if EF Peru has 3.5 million shares outstanding and these shares are trading for a price of $15 per share, what is EF Peru's market capitalization? How does the market capitalization compare to EF Peru's book value of equity in 2016? Solution: EF Peru's market cap is 3.5 million shares times $15 per share, that is $52.5 million. This market cap is significantly higher than EF Peru's book value of equity of $24.7 million. Thus, investors are willing to pay 2.13 times the amount EF Peru's shares are worth, according to their book value. Market to book ratio. In our previous example, we computed the market to book ratio, also called the price to book P over B ratio, for EF Peru, which is the ratio of its market cap to the book value of a stockholder's equity. The market to book ratio for most successful firms substantially exceeds 1, indicating that the value of the firm's assets when put to use exceeds their historical cost. Variations in this ratio reflect differences in fundamental firm characteristics as well as the value added by management. Enterprise value. A firm's market capitalization measures the market value of the firm's equity, or the value that remains after the firm has paid its debts. But what is the value of the business itself? The enterprise value of a firm, also called the total enterprise value or TEV, assesses the value of the underlying business assets, unencumbered by debt and separate from any cash and marketable securities. We compute it as follows. Enterprise value equals market value of equity plus debt minus cash. From our example, EF Peru's market cap in 2016 is $52.5 million. Its debt is $116 million. $3 million of notes payable, $14.1 million of current maturities of long-term debt, and remaining long-term debt of $98.9 million. Therefore, given its cash balance of $23.5 million, EF Peru's enterprise value is 52.5 plus 116 minus 23.5, and that is equal to $145 million. The enterprise value can be interpreted as the cost to take over the business. That is, it would cost 50.4 plus 116.7 equal to $168.5 million to buy all of EF Peru's equity and pay off its debts. But because we will acquire EF Peru's $23.5 million in cash, the net cost of the business is only $145.0 million. Bueno, eso fue todo por el video de hoy. Esperemos les sea de mucha ayuda al momento que quieran analizar una empresa y por qué no invertir en ella. En el video se intentó hablar sobre cada término técnico, pero si dudas de alguno en específico podrías dejar tus dudas en los comentarios y las responderemos. Gracias por ver el video completo, no olvides dejarnos tu like y suscribirte a nuestro canal. Nos vemos en la próxima. Bye.